Good afternoon, everyone. And for those of you that are Rotarians, welcome to your Tuesday Rotary meeting. I appreciate all of you being here. For those of you that don't recognize me or don't know who I am, I'm Gaynor Chokas. I am president of the Rotary Club this year, as you can tell from this side of my lapel. And I'm also the director of our Center for Business and Economic Development here at GSW, and it is my honor and pleasure to have all of you here with us today for this special event. I do like wearing two hats. No pressure, Dr. Heaghney, even though I'm here under two purposes today. And we are looking forward to the information that you're going to share with us. And before we get started, I'd like to ask Ms. Linda Lee Purvis, who is our Interim Vice President of Academic Affairs, to do a short welcome.
On behalf of Dr. Neil Weaver, our president here at Georgia Southwestern, our students, our faculty, our staff, I welcome you to this event and to our campus. It's a gray day outside, but as my husband says about the golf course, the sun always shines on Georgia Southwestern. So thank you all for coming. It's just our pleasure to host this annual event, and we're so glad you're here. A special welcome to Dr. Heaghney and special guest here from the city and the county, to all of our faculty and staff who are here, and to the Rotary Club. Thank you so much for choosing Georgia Southwestern as your place every Tuesday for lunch and for your meeting and for co-sponsoring this event. I wish you all a good lunch, and I know you'll be very pleased with our speaker. Thank you.
This is the 23rd event in this series. Some of you may remember Dr. John Bates. He was the first person who initiated this program when he was here at Georgia Southwestern. And some of you may remember that it used to be held at 7 a.m., which was certainly an early morning affair, but it was still very well attended. And then a few years ago, of course, we decided that we would move it to a lunch time frame, and we're so pleased that the Rotary Club has always been our co-sponsor to the event. And with that, I am also going to ask my husband, Mike Chokas, who is the representative from the 2nd Congressional District for the State School Board, to introduce our speaker today.
Thank you, honey. Our honey president, I'm sorry. Anyway, I have to kiss the ring. It's a great pleasure for me to introduce Ken Heaghney, our state economist. When I was in the legislature, one of the first things we did, as a matter of fact, it was this Tuesday, right after the Martin Luther King celebration, we would meet in the budget briefing room of 341 at the Capitol and have a litany of people coming and present proposals, starting, of course, with the governor, and he would give us his budget recommendation for the year. Well, all that was based on Ken's numbers and Ken's research. He's our state economist. And he would give his recommendation to the governor months earlier so that we could prepare a proposed budget, or so the governor could prepare a proposed budget. He's a research professor of economics at the Andrew Young School of Policy Studies at Georgia State University. And when I was in the legislature, I enjoyed talking with him and getting insights into the economic outlook and prospects for our state, and also in reference to the nation and other states. But for him to predict what the economy is going to be over the next year, I really took the liberty of trying to find out, did a little bit of investigation. So I called his secretary, and I talked with Ken's secretary, and she told me that all these facts and all these figures and all these numbers he derives from a crystal ball that he keeps on his desk at all times. And he's been very successful at it. So Please join me in welcoming Ken Heaghney to this Economic Outlook program.
Well, I knew he was making a joke when he said he talked to my secretary because they don't give me one. So we're a very tight spending organization at the state government, and so if you don't need one, you don't get one. What I thought I'd do today was do essentially what I did for the Joint Appropriations Committee back in early January, day after Martin Luther King Day. And because you have more time than they did, I've added a few extra bits of information that might be of interest. But it's essentially the same theme, and it's a month later. Those of you who are invested in the stock market may be a little queasy, but fundamentally nothing has really changed with the state of the economy or the current outlook. A lot of uncertainty due to financial gyrations, but things overall haven't really changed. Fundamentals are still good. So I thought I'd do three things. Talk about our fiscal situation as we close out the last fiscal year, 2017, last end of June. Talk about the economic trend and outlook. What factors underlie my analysis to produce a revenue forecast that the governor can then use as his starting point for setting the revenue estimate for the budget. And then just summarize where we ended up at the end of our discussions in early December, and that what's embedded in the current budget proposal before the legislature. So in 2017, our revenue collections totaled 4.7% growth year over year. That's the general fund. We had planned on growth of 3.1%. So in my world, as the revenue forecaster, I'm always happy if the actuals exceed the estimate. If the actuals are short of the estimate, everybody's very mad because lots of bad things happen. Spending has to be cut at the last minute. We draw down our reserve funds, and people really remember that. And we went through that in the Great Recession. But over the last few years, we've consistently been able to be very conservative in our forecast. Revenue growth has exceeded the plan, and that leads to what has made the rating agencies, the governor's office, the legislature pretty happy. We built up our savings account, the revenue shortfall reserve. So at the end of a fiscal year, every dollar that we've collected that exceeds how much we spend goes into the RSR, and that builds up over time. And so at the end of fiscal year 2017, we have about $2.3 billion in savings or in our reserve account. And that's a big number, but it's not big when you start going through tough times. And so you can see in the previous recession, we went through $1.5 billion pretty quick. Some of it was planned because the government said, I don't want to cut spending that much, so we'll appropriate dollars out of the reserve. But a lot of it was unplanned. The economy collapsed, revenue collections collapsed, and it takes a while to adjust spending and really, frankly, anticipate just how low things could go in that Great Recession. But right now, we're back in a good position, about $2.3 billion in revenue. Governor Deals announced he would like to have $2.5 billion in there by the time he leaves office next January. But right now, we're from a RSR standpoint, we're in good shape. This helps us get the AAA rating from all three bond rating agencies. That lowers our cost of borrowing and makes it, it's a signal to outside businesses that we are a state that's well run fiscally. So a lot of good benefits derived from that. As we get through the middle, we've gone through half of fiscal year 2018. And so far this year, our revenue growth is 6.2%. Based on the existing budget for 2019, we need 1.9% growth to meet that budget. So we're well ahead of the plan. And that, when you have that big a gap between what you need to get and what you're getting, a clamor starts to go up to raise the revenue estimate. And we're resisting that, and I'll explain why in a minute. So where's the revenue come from? Our biggest source is withholding. That's the upper chart there. And withholding's doing pretty well, but not spectacularly. So that tells us our labor market's good. We're seeing wage growth, job growth, and we're growing at about, year-to-date, about 5.1%. So solid, but not spectacular. On the bottom right, you see the sales tax chart. The blue line is combined state and local revenues, and that's doing quite well, but it's also driven by, in Atlanta, we've implemented an extra sales tax, the transportation sales tax. That's generating about $15 million a month. We're also seeing our Department of Revenue clean up some old returns, which has boosted collections for the local government. And at the state level, we see much slower growth, around, what is that, around 3% growth on trend. So again, good growth, but not spectacular. So two of our biggest sources, withholding, general sales tax, are growing at decent but not spectacular rates. So how do we get to 6.2%? And we get there because of what's happened in the last 2 months. So in addition to the withholding tax we all pay on our salaries, other people pay estimated payments. They're typically business owners, investors, people like that who have non-wage income and pay quarterly because they know they're going to have a year-end obligation for that income. And through those kinds of payments, estimated payments and returns and a few other things, we're growing at about 2.3% through November. So pretty weak growth, especially given the state of the economy. And then all of a sudden, revenue started raining in on us in December and January. And so why is that? Has the economy changed? Have people changed their behavior? I think it's more people have changed their behavior. What's the biggest thing that happened in December? Federal government passed their tax bill. What's the biggest change for people who pay state taxes? In 2018, you won't be able to deduct more than $10,000 in state and local income tax. So that cap gives people an incentive to pay their April amount due early, late December, early January. So they pay estimated taxes then rather than in April. The state sees a huge gain in late December, early January, but then we get to April and we start saying, where's the rest of this money? So we're very cautious about how we interpret this large growth over the last 2 months. We think it's more a shift in payments rather than a sudden change in the underlying economics. And so that's why you'll see Governor Deal, I think, resist trying to fool around with the revenue estimate at this point. Saw a similar situation with corporate payments. Very low first 4 months of the year in terms of growth, and then all of a sudden, November or December, January, we saw pretty spectacular growth. So again, we're pretty cautious about interpreting that as a change in the revenue trend, and so we're pretty happy with where we are. Just as a matter of local information, tried to look at kind of the sales tax performance in this region. And I first looked at Sumpter County and couldn't make sense of it, to be honest. Spectacular growth last year, negative, very negative growth this year. I think there must have been some large assessment payment somebody had to make. So I looked at the River Valley region, which you're part of. And what you see is fairly weak performance. This is the lost tax, the local option sales tax revenue. And both calendar year 16, calendar year 17, we're seeing a small decrease in revenue. So symptomatic of an economy not growing at a spectacular rate. Okay. And this is a small enough group. If people have questions as we go through, feel free to ask. That can work. So let's talk about the economy. Kind of a few bullet points. We're near full employment. Job growth is sturdy. Unemployment is low, whether you look at kind of the rate that's publicized, the U3 rate that they publicize every month, or the broader rates that try and look at underemployment. They're both low and below where they were prior to the recession, the Great Recession. Wage growth is pretty weak. It's modest, let's say, but showing some signs of strengthening, at least in the latest labor market report. So that's an important fact of where we are. Consumer sector is growing moderately. Businesses are in good shape overall. This is at the national level. Investments up, activity measures are up. Housing's doing fine, not spectacularly, but we are growing. And also importantly, inflation is below target. So we're kind of in a pretty good position of very low employment, low inflation, and low interest rates. So all those things are positive. In terms of employment, the U.S. added a little over 2 million jobs in calendar year 2017. It's down a tiny bit from 2016, but essentially you would say there's no material difference between labor market performance in 16 versus 17. In Georgia, we added about 83,000 jobs in that calendar year. Again, down a bit from the prior year, but still sturdy growth. And if you compare growth in the U.S. to growth in Georgia, what you see is that Georgia is growing faster than the U.S. in terms of percentages. But you also see both Georgia and the U.S. growth rates declining slightly. Still good rates, but starting to slow down. So why is that? Is it that the economy is getting weaker? And I think my answer is no. It's that we're at or near full employment, which makes it harder and harder for companies to find the right workers with the right skills at a wage they're willing to pay. And so they've, if you look at job openings data, we're near record highs. The hiring is low, so there's a gap between those two. And so what you would expect, classically, I guess, is that people would start to raise wages to bring the right people into those jobs. We're starting to see that a bit, but not enough to really be convincing quite yet. But I think the story here is consistent with that full employment story. Job growth is there, job opportunities are there, but the rate at which they're being filled is starting to slow more because of labor scarcity than lack of need. And you can see that in the unemployment numbers. I think the U.S. is at 4 or 4.1%. Georgia's marginally higher. When we were, 2 or 3 years ago, economists talked about full employment being, 5.5%, but we've kind of blown past that. We're at 4%. So again, a very good position in terms of if you have skills, if you want a job, the opportunities are there, at least in the national and the state level economies. And then when we look at the Georgia unemployment data in a little more detail, I think that it's still a very good story. So the gold bars show the change in household unemployment by month. And what you see is pretty consistent growth every month except for last December for some reason. And then the blue bars are the labor force. And again, we see growth in the labor force pretty much every month over this time period. And so what's driving the unemployment rate? We got two things that move against each other. The labor force is growing, so that tends to push the unemployment rate higher. But unemployment, or the employment level, is also growing. And so the employment rate is growing faster than the growth in the labor force, and that's pushing the the unemployment rate down. It's really important that people are coming into the labor force, that is growing. And the reason is it's really a vote of confidence in Georgia's labor market. People are confident they can get a job, they're willing to invest time and effort to find one, and they're doing that consistently month after month after month in the state. So that's a very good positive sign that our labor market's strong and continuing to grow. We see it in the unemployment insurance claims. They've been incredibly low for a year or more, and so that's another sign that job opportunities are there. Firms are reluctant to lay people off, a sign of the scarcity of labor in many respects, scarcity of the right kind of labor. When we look at where employment growth is in the state, these are all the major sectors that the Bureau of Labor Statistics tracks. And you can see there's only one sector where we're seeing year-over-year declines, manufacturing. Excuse me, every other sector is growing at a pretty healthy rate. Professional and business services tends to be a relatively high-paid sector. It's the growth leader in Georgia. Manufacturing is lagging. Manufacturing activity is not really, but I think it's more of a productivity story. Manufacturers are able to produce more and more with fewer and fewer people. So we produce more, but we have less employment concentration in that area. So again, well-diversified growth, a sign of the strength of the economy, that we're not dependent on one or two sectors for growth, but we have growth across many sectors. When we look at the metro areas across Georgia, where we see the growth concentrated is North Georgia and coastal Georgia. So Athens, Augusta, Savannah, Gainesville, Atlanta, all growing at a 2% or greater rate over the last year over year as of December. So those are the leaders, and then there's a noticeable decline, but down to the next level. Warner Robins, even more so Valdosta, Dalton, Rome, Columbus. So most of the southern metro areas are growing but lagging, is the way I would put it. And then the Rome-Dalton area, where so much is dependent on textile manufacturing, still growing but not rapidly. So I thought I'd try and put together a chart showing how Sumpter County growth stacks up against Georgia. The problem with dealing with county level data is it's pretty erratic. There's not a lot of stability in it, and so you get these wild swings in growth rates. But I think the message overall is that employment growth is fairly weak compared to Georgia. So and this data only goes through mid-2017 because of the time lag. But it's not trying to think of the right way to phrase this, sorry. So growth is not as robust as all of you would like, I'm sure. Let's put it that way. The lower right corner shows wage growth, and generally a similar story, but not as dramatic. I think the wage growth here has been a little better compared to the employment level growth. Let's talk about consumers for a bit. This chart shows real consumer spending growth on a monthly basis, year over year. And what you see is growth in the high 2% range, 2.6 to 2.8%. So reasonable below where it was a few years ago, but as we'd expect, there's no pent-up demand left, and so that level is pretty solid considering where we are in the business cycle. So why are consumers spending more? What are the drivers? First is wealth. And what we see here is just a spectacular growth in household wealth since the depths of the recession. Up over $96 trillion. We went into the Great Recession with about 66 trillion, lost a bunch of that with the collapse in the stock market, the drop in housing prices. And since then, it's just been a pretty steady ski slope straight up. If somebody did a forecast like that, nobody would believe it because it's such a kind of straight line, straight up kind of thing. So what drove it? Obviously the stock market. We've had, over that period, we've seen the S&P index go up by a tremendous amount. We've seen housing recover, and so those are the two main asset classes for households. So when people have more wealth, what do? They're a little more comfortable spending. They can convert it into liquid assets and spend, or they can just say, hey, I don't need to save quite as much anymore. I'll just buy that car I wanted. So that's driving consumer spending. The other factor is real disposable income is growing. And you see here it's at about 2% year over year. So it tailed off a bit and then has recovered. The other thing to note is we were seeing spending growth of 2.8%. We have income growth of 2%. And so you start to think, how can that last? How long can it last? How do we make up the difference? And there's two primary ways you can do it. One is to borrow, right? So these are credit balances for households or consumers. The red line is revolving credit. That's your credit card. That's that Visa card sitting in your pocket. And then the blue line is non-revolving credit. Think student loans or auto loans. And what we saw is that the non-revolving credit, the auto loans and student loans, flattened during the Great Recession, but never really stopped growing. And they have continued to grow pretty quickly. So when you read about people worrying about student loan debt, that line is why, the spectacular growth in that. You can see the credit card debt, the red line, behaved dramatically differently. So we collapsed pretty quickly in a very short period of time. And honestly, that was not people being parsimonious and paying down their credit. That was credit card companies just writing off bad debt. And since then, we've grew slowly, and now we're growing fairly quickly in terms of mortgage or consumer credit. So that there's some limit there. We don't know where it is, but we're seeing consumers using more and more credit card debt to fund their spending. So that, to me, that's a caution that consumers' spending is not positioned right now to be a big driver of the economy beyond where it is, without more wage growth, more real income growth. The other thing people can do is quit saving. And so that green line is the saving rate, and it's a very messy chart. I apologize for that. But what you see is that over the last couple years, or I'm sure, yeah, a couple years, the savings rate has plummeted back down towards near the low in this entire series. So you put that together with the credit card debt, what do we see? Consumer spending supported by more credit card debt, less savings, and to the extent auto loans are in that non-revolving credit, borrowing for autos. So that's a story where we're starting to get a little nervous. And then the red line there is a calculation of the fixed monthly payments that households have divided by their disposable income. So again, what we see is that trending up, Still well below where it was prior to the Great Recession, so, I mean, that's good. But the thing, these two charts, these two lines are moving in the wrong direction for long-term growth prospects. We see households becoming more leveraged in essence and saving less for their future. So one of the cautions I have, more for the medium term than the near term, is that the household sector really needs wage growth to continue to spend at its current level. So my one semi-negative in this. And you have to remember, I'm an economist, and that's the dismal science, so we're never too upbeat. So businesses are in good shape. This chart shows the Institute of Supply Management indices for manufacturing, which is the green line, and services, which is the gold line or yellow line. If the value of that index is above 50%, that means the sector is expanding. If it's below 50%, it's shrinking. And so what we see is that not only are they both well above 50, almost to 60, they've been strengthening over the last period of time. So overall, that trend is up. So that tells me that businesses are in very good shape. They've got a lot of business to continue in their operations and support their operations. And so that's a very good sign. Some of the weakness earlier in the manufacturing was really tied to the collapse in oil prices when the drilling activity collapsed. That's bounced back, and manufacturing has bounced back. And when business is good, businesses invest more. And so again, we saw the very significant decline in business investment in equipment when oil prices fell and the dollar ramped way up. Both of those are in better position now, and we see business investment growing 10% year over year, and that's a very good rate. So again, business is doing very well, and a very positive sign for the economy. Housing is pretty good, but still well below where it was prior to the recession. So the red line is U.S. housing starts, and the blue line is starts in Georgia. And they move almost in lockstep. And they're both generally trending up. They've kind of weakened a little bit in the last 6 months or so, but I don't think that's really a change in trend, more a volatility thing. But what you see is that they're still well below where they were in 2006 and 7. So we've got a long way to go for that sector to be as big as it was back then. And then in terms of prices, this is the price for the Atlanta metro area, and then the S&P index for 20 large metro areas across the U.S. And again, there were some huge swings earlier in the decade, but right now they're growing pretty much at the same rate, small difference with the U.S. rate, the composite 20 rate growing slightly faster than Atlanta. So again, pretty solid growth, a little over 5%, faster than income growth, which makes you worry about affordability, especially with interest rates starting to rise. The other thing to note is it was just a few months ago that Atlanta area index finally reached the peak prior to the recession. So I think that was in 2007. Here it is 11 years later, and we're just now getting back to that point. So a lot of value lost. It's built back up, but if you were judging your 2005 home purchase on cash flow rate of return basis, you wouldn't be too happy with yourself. And then inflation is still very low. We're seeing the Fed take steps to raise interest rates, but the personal consumption expenditure core index is growing at about 1.5% year over year. Target rate's 2% year over year. And so from an inflation perspective, you would think we've got room to not raise interest rates. I think the reason they are doing it is because they think they're causing repercussions in other asset markets. The boom in the stock market partially supported by very loose money, and they're just trying to slowly pull that out of the monetary system. So I think even though inflation's low, we'll continue to see interest rate policy changes over the course of the next few years until we get back to more normal levels. And as long as the real economy stays strong. So when we did our forecast for the governor for the budget, the principles we used were that the U.S. and Georgia economic growth will continue at a moderate pace through 2017, 18, and 19. And the most likely scenario is that it's going to be at about that same pace, not significantly faster, not significantly slower, through the end of the 2019 budget year. I think most importantly, the fundamentals are good, whether you look at labor markets, consumer spending, business activity, business investment, household balance sheets, they're in good shape. And low inflation gives us some policy room on the monetary side. I think that those factors are true both for the U.S. and for the overall Georgia economy. Well, I think about where's the upside and downside risks from, I think of two things. Downside is from monetary policy. I think we've gotten a little bit of taste of that over the last few weeks with the stock market. As the Fed raises the interest rates, that's going to create repercussions is too strong a word, but it's going to affect how people, investors, view the stock market, bonds, et cetera. It's going to have repercussions for the financial market. I think what we saw a couple weeks ago was Fed had raised rates in early December. The jobs report came out in early January. We saw solid job growth, higher wage inflation. Investors started to get a little spooked about higher inflation and started to switch out of equities into other assets. And we saw quite a roller coaster ride. I think people calmed down after a few days, and so then they bounce back a little bit. But I guess today, when I looked right before this session, we were down about another 100 points on the Dow. So I think one thing we'll see, and without saying anything about overall levels, I think we're going to see a lot more volatility than we've seen over the last few years. The stock market has been very calm, and if you look at the volatility measures, they've been very low, and now they're gone way back up. And so I think we'll continue to see that. Where do we get upside potential? I think we did have the federal tax law changes, and that could be a boost, particularly in the immediate term, next year or two, and that could drive growth a little bit higher than what we've seen historically. So when we put all that together, for the budget, for the current budget, we came up with overall growth of about 2.3%. As I mentioned, we're tracking well ahead of that. So we raised the existing 18 budget a little bit. That's two things. One, me being very cautious. The other being Governor Deal being very cautious and not believing the midterm budget should be used to fund new activities, but only fix holes in the existing budget. And so that's both of those factors play into that. And then for next fiscal year, the one that will start on July 1 of this year, slightly faster growth, 3.8% in taxes, 3.7% in overall general funds. We're swimming upstream on a couple things. The motor fuel tax doesn't grow very much, a couple percent a year, so that holds down growth. And then if those of you who bought a car in the last 3 or 4 years have paid a title ad valorem tax instead of a sales tax. And what's happening with that is each January 1st, we switch how much of the 7% tax goes to the state, how much goes to the local government. And we're at the phase where each year we expect more and more of that to go to the local governments. And that means our revenue growth from that tax at the state level is significantly negative. And so that holds down our anticipated growth rate. So that's my story. I hope I didn't disappoint my host. Okay?
Any other questions?
Thank you.
Thank you very much. I'm Dr. Liz Wilson, Dean of the School of Business here at Georgia Southwestern, and we house the Center for Business Economic Development and support Dr. Chokas in the work that she does as the director of that program. So thank you, Gaynor. Thank you to Dr. Ken Heaghney. We appreciate you coming down and sharing your information with us. Thank you to the Americas Rotary Club for sponsoring this. As good partners with many of you, the School of Business appreciates your continued support for what we do in the business school and what Georgia Southwestern does in this community, especially on economic level. So thank you all very much for coming. Y'all have a great afternoon, and we will see you soon. Thank you.